Well, welcome to today's podcast with the two Pauls. Paul's been on with us about 5 months ago now, so I'm really pleased he's coming back today. Before we get started, we have to do the usual kind of legal stuff, which means that everything in today's discussion, I would call it, between us, is not intended to be trading or investment advice. This is purely for informational and educational purposes. So with that, welcome, Paul. Thanks for coming back. I always enjoy our chats. I know, obviously, people know that Paul and I are really good friends and we chat offline, but I'm pleased he's come back today to discuss things in this public forum.
Hello. Thanks for having me again. It's always my pleasure. So, yeah, let's get into it.
So, yeah, I think the first thing we were going to talk about is, which is probably no surprise, is US interest rates and your current perspective on what's going on, because for a long time there's always been this attitude, particularly even in mainstream the financial press, etc. They're going to cut interest rates, and then they don't. They're going to cut interest rates, and markets started to react on the basis of the assumption they were cutting interest rates, and of course they didn't thus far, but there's big expectation that shortly they will cut interest rates. So I think that's a good starting point.
Yeah, last time we spoke, we kind of had these predictions of when they're gonna cut. And I think I've said sometime in the summer, so that was obviously wrong. But the Fed meeting is this week. We're in the middle of September. They're definitely cutting. The question is it 25 basis points or 50? I don't think it matters that much, but that's the debate. So we kind of missed it, but not by too much, right? Almost got it. And I think, yeah, so my perspective, well, the actual size of the cut is not that important, but I think the actual fact that they are entering this easing cycle is very important because it means that we are going to be in this regime for a year or two at least. And obviously that has implications. There's a lot of talk about the Fed being heroes and, defeating inflation. But actually, my point of view is that, this first cut is an admission of problems. You've seen the shift in tone by the Federal Reserve. They increasingly talking about the labor market, and it's no coincidence. We had these huge revisions, annual revisions that were very negative. So yeah, the fact that the cuts are coming and the fact that the curve is steepening, I think these are key developments that you have to kind of take into consideration if you're thinking about asset allocation or macro developments. Yeah. So what do you think? What's your take?
Yeah, well, I think, I've said this publicly. I've said it in my own podcast. I've said it publicly. I think we talked about this obviously last time and on platforms like X, where for me, the whole point of raising interest rates was all really nothing to do with trying to combat inflation. It was to defend the dollar. And I think they've spent so long where in any normal, I would call, economic cycle, they would have already looked to cut interest rates because the damage it's doing to the real economy is a reality. We're starting to see clear indications again of it impacting financial institutions, more the sort of mid-range regional banks, etc. And for them to then start to have to cut rates, I think is an admission, for me at least, that they can no longer defend the dollar. Okay, how long the cycle lasts? Well, that's a great question. And there's a possibility that this is kind of a watershed moment in the realization that, with this rapidly expanding budget deficit, what was it in the month of August, $380 billion? Okay, that doesn't We shouldn't
Crazy.
necessarily extrapolate that across the year because August is always a pretty bad month. But still, we might be in a cycle where how long does QE last and what is the implications? Because they are going to have to go to QE. It's irrefutable. And to what extent will they have to do so? And what's the broader implications in doing that? I mean, I think for me, that's the interesting part as well.
Yeah, well, we're still in QT, right, at the moment. So you would think that they would stop the program before cutting rates, but obviously they won't. It doesn't make much sense to me, but I guess that's the plan, and it's kind of contradictory, right? Because one is a liquidity drain, another is a, liquidity input kind of thing. So there's no good reason to do both. QE, yes, but which form? I don't know. Maybe it will be the balance sheets of commercial banks in US rather than the Federal Reserve, or maybe both. So I think we could see some variation, right? It might be not as we've seen in '08. Say maybe it will be a combination of this. We have the Treasury manipulating the curve as well with their buybacks. So that's something new. They tried something like that in '08, '09, I think, but it was very brief. So you have, in terms of programs, I think there's a lot of uncertainty. I would also add that to me, the fiscal side is pretty critical because we are in election year. You couldn't get two candidates that would be more different, right? The only thing they agree on is that they'll spend away in different ways probably, but they will be spending. And I guess depending on how bad the economy is, the spending will be proportional to that. The economy is, if we're talking U.S. economy, it's likely slowing down. It's not at critical levels yet, but labor data in particular is worrisome. I mentioned the revisions. Consumers are kind of overweight debt. They continue to borrow. If you look at revolving credit, which is basically credit cards, it keeps making new highs at the same time as the savings rate is going down, right? So some sort of stimulation is obviously coming. The question is, how will this translate into, the money mass? What programs, like fiscally, are they just going to subsidize something, or are they going to, do helicopter money like 2020 style? So these are the questions. I think it will be much clearer by the year end kind of thing. That's my take, at least. That's what I'm waiting for.
Yes, and that's completely logical given they'll start to implement rate cuts, or should do this week. I always say should do because you can never be 100% certain, but assuming they do, then yes, logically that process follows. But one thing I would add for me, I think the US economy is a lot weaker than conventional wisdom suggests. And there's a lot of data which clearly supports the viewpoint that they made all these statements post the sort of start of the pandemic, and they claimed that all these Americans had all these savings, trillions of dollars in savings, and they were ready to spend it into the economy. And I never kind of bought this personally. But what we certainly see now is that increasingly people don't have any savings. They are basically spending using credit for essential items. And we're seeing more, clearly a spike in the total amount of credit amongst American consumers, but also the default rates going up. So there's a lot of data that supports the view that Americans increasingly are struggling to make ends meet and just pay for the basics. So for me, that's a broader implication that the economy is weaker than conventional wisdom would suggest. And also, I think there's increasing evidence to support the view that businesses are struggling because of the higher interest rate environment and a number of other broader metrics. because, I mean, at the end of the day, Western economies depend on consumption. So if consumption starts to fall off the proverbial cliff edge, then that has ramifications for the broader economy. So I think the idea they can carry on with QT, just a small point, I think they're at the cusp where they can't do that anymore, and they'll have to stop doing that. Whether that means they're going to just jump straight to QE, or they'll try and fudge it and say it's not QE. We've heard that before as well. So
For the second time, yeah.
Yeah, so the next few months we await with interest, what developments come on the back of interest rate cuts, and what those cuts mean initially for broader markets. So, for example, what just a small, completely trivial point in terms of the conversation, but what does that do for the price of gold as one example, and what does it mean for the dollar as well? It's just, I mean, I'm not throwing answers out at this point because I don't think it's wise to do so, but these are just some small points amongst many to consider once they do cut rates.
I think when it comes to the US consumer, I think we kind of have two different economies, one for the rich and one for the poor. Let's stick to those terms. And the rich, and by rich, I mean guys with assets, right? With financial assets or liquidity. So it doesn't have to be a high net worth kind of guy, but just someone who has some stocks and bonds and whatever. And I think these guys, the guys that have the assets, they are actually spending, and you can see it in the data. But the guys that don't are increasingly having problems, and that's where the credit card stuff comes in, right?
Mm-hmm.
So I think there are like two economies, and when excess savings are calculated, they are calculated for the totality of the economy. But the guys that actually have the savings are the smaller percentage of the population, right? So, and the bigger your capital, the less you spend, really. I mean, you can't drive 5 cars, okay? You can collect cars, but realistically, you don't need it, So I think that's why you get conflicting signals from the consumer kind of thing. I would also add, coming just to finish off on the interest rate stuff, I think the steep and basically the normalization of the curve is absolutely critical. It's historically, it just means that we are very, very close to an economic slowdown. And this coupled with these revisions that are all over the place and, all these problems and the fact that the US government needs to pay so much interest that it's increasingly becoming one of the bigger portions of spending. I think those are the real reasons. Inflation coming down kind of helped them, but with the Fed fighting inflation, it's a bit like the guy who started the fire putting it out at the same time, right? So it was their policies that led to it. Well, their monetary policies supporting the fiscal push in 2020 is what really drove the inflation, because all these problems with supply chains, they were kind of short term and they kind of fixed themselves, really. So it was all them. It was all that money going into the economy and people having just pockets full of money that fueled the demand for goods, at least. So I don't really believe that. Just like you, I think there are other reasons, and one of the obvious reasons to cut is because they see problems ahead, basically.
Yeah, absolutely. So yeah, should we move on to the next point then?
Sure.
Right. Okay. So the next point on our list is oil, and that's always, I think, keen interest. I mean, I don't profess to have very in-depth knowledge of oil markets, but I understand enough on a superficial level, I think, to appreciate what's going on and what has been going on. So let's go talk about oil then.
Yeah. So coming back to our last conversation again, at that time, oil was kind of pushing 90 on WTI. And if I remember correctly, I was kind of worried about prices above 90. We never got there, but we did pull back. So we're trading at around 70 right now for WTI, so 75 Brent, maybe 80 for Saudi oil. And again, I'm not a huge kind of expert on oil, but we do trade it once in a while, and we do have exposure through oil stocks from various places, also US. Um, and but in direct exposure, we've been kind of careful. You know, we would be buying call options with limited kind of downside. At current levels, we're a little bit more aggressive for the reasons that I'm going to talk about, but it's still a very small position proportional to other assets, other asset allocations. So I think it's an interesting time for oil because there's a lot of kind of misinformation flying around. The stuff I look at, for me, just like with interest rates, time curves are important, and all commodities, they kind of have their own curves in time. So, you can trade oil for today's delivery or, next month's delivery, or whatever. And you can go down the curve and trade, I don't know, 6 months out, a year out, etc. And the prices are different, right? They're not like the spot. So the curve has been shifting, and I was always waiting for the curve to enter contango. When prices on longer dated futures are higher than the short-term futures, the frontal futures. And we're not there yet, but we're kind of flatlining. So so the spread between, say, 1 year and your frontal contract has been narrowing. And for me, and quite substantially over the year, say over the last 12 months. And I think we could get some sort of event on the short end. I don't know, whatever it may be. We could get prices lower on the frontal, like we saw in 2020, if you remember, when COVID hit and, uh,
Yeah,
short-term futures were negative at some point.
yeah, yeah.
So we could get something like that theoretically, but the curve itself is very important, I think, and it gives you a kind of a bullish indication, at least for me. So I can be a little bit more aggressive, but it's still early days. I think the paper side of trading is interesting. There seems to be a push down, like the short position is fairly large on derivatives, on CME, on NYMEX, whatever it is. And, the bullish sentiment is worse than '08 or 20. And it doesn't really make much sense because there's no indication that global demand is slowing. It's actually going higher. And I would like to remind everyone that when OPEC Plus did their cuts a year ago, when they started doing that, the main reason for doing it was the expectation that global demand could suffer, and in particular, US demand could go down. So if you believe that we are close to recession and there will be a slowdown, and oil shut down because of that, well, the OPEC guys kind of got it right. Global demand is still going up, like I said. I think it's around 104 million barrels per day now. I don't see why it would go lower. Another reason to be bullish is because global inventories are historically low for this particular time of the year. Like if you do comparisons of previous cycles, the inventories are pretty low. There's a lot of manipulation coming from EIA. They also have these adjustment factors, just imagining these inventories weekly. In terms of strategic petroleum reserve, Americans have been buying some in very small kind of increments, but at least they're not selling. But at the same time, the current admin has been releasing petroleum. So there's still some manipulation on the physical side, I would say. I guess the negative sentiment is kind of powered by expectations of a slowdown in US, but also maybe it's something to do with what Trump is saying. He's very heavy on his views on the oil industry. He wants American companies to drill more so than than they're doing right now. He keeps talking about how he'll get the price down when he's president if he wins. So maybe some of that is being priced in. But it remains to be a critical resource, right? So it's critical what's going to happen. And I also think that this move in gold, it kind of makes oil prices at these levels suspect, because if one thing is supply and demand for oil, global and US, and it's kind of part of the equation, but the other part is the loss of purchasing power by the dollar and other currencies. So if you believe that part of the equation, oil prices should follow gold kind of thing, because both gold and oil are critical for BRICS. And in order for that trade to be predictable, you want this ratio of gold to oil to be as predictable and as stable as possible. So if you kind of think that gold is going to stay high or even go higher, then I think it's a good idea to believe that oil could be higher as well in dollar terms. So yeah, interesting time. I'm not a huge oil trader. I'm sure there are people much more knowledgeable than me, but that's my take at least.
Well, thanks for that. The only things I would add to that from my perspective with regards to OPEC Plus and the Saudis and the Russians, of course, Russia has their own reason why they want the oil price as high as possible, given, of course, they're fighting a war, amongst other things. And from the Saudi perspective, they need oil prices higher. So cuts can also actually be stated as, well, we're responding to the anticipation of a global slowdown. But in fact, that might be more of the reason why they're doing so. And with respect to the whole idea of when in the West or we hear about a global slowdown, what they basically mean is the West, because as far as they're concerned, the global South doesn't exist. So they don't pay attention to what's happening in global South economies. And okay, there's no doubt if the West suffers a very serious recession, stroke depression, just for argument's sake, then it's going to impact them. And we're not disputing that. But I think sometimes we tend to, not we as in Paul and I, but we in the West tend to disregard any data or any actual economic development which is happening in the global South. And there is enormous development going on. And Russia's rotating a lot of its energy markets to Southeast Asia, to the ASEAN countries, etc., and who have a huge demand for energy. The African nations do. So there is a shift in global markets as well that we have to factor into the equation, and that often gets forgotten as well. And I think with regards to the idea of US and Trump saying we must drill more, well, for me, and this is maybe controversial in some people's eyes, I think shale oil and gas in the US has peaked. They can, the low-hanging fruits long since gone. And yes, you can go and spend enormous amounts of money because it's very capital intensive to drill everywhere and looking for more oil and gas. Are they going to find it? Well, it's highly debatable. And the question is, how quickly, if the US has peaked, or is the oil and gas production going to fall? And with shale, it could happen. I'm not trying to be dramatic about this, but it can fall relatively quickly, quite sharply. I'm not saying it goes to zero instantly, because of course that's nonsense, but it could start to fall quite significantly. And what does that mean for the broader global demand, and what's that going to do to oil and gas prices? And so those the sort of things I'm thinking about from my perspective. And I can understand why Trump's saying what he's saying, but it's election cycle. Trump will say anything because it sounds like it's an election winning statement. Whether the reality can be obviously very different. And I don't think it's just a question, well, go and spend huge sums of money and we'll miraculously find all this oil and gas. That's a very naive perspective to take, I think.
Yeah, in terms of shale, I think it's only the Permian Basin that kind of supports this production increases. Yeah, it's one thing to say it and another thing to do it. But if you look at Trump's previous record, he did ramp up the production quite significantly. It made US one of the top producers. There are certain issues with the grade and, the stuff you talk about in terms of how much of the stuff is out there. But, I think Trump realizes how critical oil is, unlike current admin. I think that's positive, but whether he can actually deliver okay, say the shale industry in US produces, say, 2 million more per day. It's still oil of a very particular grade. It doesn't solve all the problems that US has. It might have a marginal impact on prices, theoretically, but it's not a given. It's given the importance of grades. I'm not sure it solves any problems of US as they stand. I think also if we're talking about oil in dollar terms, it's important to remember that we still have pegs in Arab countries, in particular UAE and Saudis. So, I mentioned the time curve changing as some indication for me that, the environment is changing and it's worth looking at it from a more bullish perspective. But in reality, dollar pricing of oil will end with depegging of dollar real, So, and we haven't seen that. We might see that, especially if we see, dollar going down on cross rates and increasingly so against gold. I think as we see more of that, the Saudis will be more inclined to get rid of the peg. It's obviously not just an economic decision, it's a political decision too. So I guess the currency pegs will be critical in terms of oil price.
Yeah, absolutely. And just a small point to end on. It's now been reported, or I would say there are suggestions or claims that in the last 2 years or so that Saudi secretly been buying maybe as much as 160 tons of gold. Now, they've certainly been buying gold. We know that to be correct. What the actual figures are, I'm not saying they're wrong in saying 160 tons, but I think it's very telling that all ties in with a lot of this kind of development that's happened, ironically, and some people say it's coincidence. I don't think it is, since the start of the Ukraine war. And it ties in with that period. And I think that's a very telling statement that Saudi is, if indeed these figures are correct, is buying that kind of tonnage of gold. and it's in keeping with a lot of other so-called what you bracket them in as being global South countries. So I thought it's worth throwing that into the mix in terms of this part of the conversation.
Yeah, it's not just Saudis. It's
No,
pretty
of
much
course not.
everyone. Also, central banks in Europe, the ones that are not dumb, they are increasingly buying gold. So yeah, but it could be them preparing for the DPEG kind of thing.
Yeah.
In terms of economic theory, nothing motivates them more than a decrease in, dollar against other currencies and the loss of purchasing power. If you think about it, oil has not kept up with official inflation in US, despite it being denominated in dollars. And I think that is what pissing off the Saudis most. It's like the US didn't keep their part of the agreement. So
Well, there's a surprise.
yeah, well, yeah, it was still a good period for them, right? The monarchies kind of stayed where they are and they got richer, but not as rich as they should have been. And that would piss me off at least.
Well, they had a good run in relative terms with the US, but like all agreements with the US, they eventually renege on them. But anyway, enough of that. Let's move on. So, the next topic we wanted to talk about is tech and chips. And what's your perspective? I know this is a pretty hot topic. I think there's a huge misunderstanding from my perspective with regards to what China's doing and the Chinese reaction to the fact that the US tried to cripple Huawei, which has failed, and they tried to effectively sanction China and try and destroy their access to the chip market, thinking we're going to cause enormous damage to the Chinese economy. And of course, there is a whole story that's developed that I think, as part of this discussion, it's worth, highlighting to the listeners.
Yeah, so technology is as critical as critical commodities. You kind of can't separate the two. We've talked about this idea that you need to control critical technology, critical commodity, and then the kind of the reserve collateral and what you transact in. It kind of comes on its own if you control these two. So obviously, chips and semis are the critical technology of today. And it's understandable why US is trying to fight it and keep, the edge, so to say. But I think it's failing. First of all, I'm against all types of tariffs, sanctions, restrictions. I don't think it achieves the results that the guys that enact them kind of strive for. And in certain cases, it could be counterproductive. And I think in this case, it's counterproductive because what it did, it's just like the freezing of Russian CB reserves led to a substitution process of U.S. treasuries into gold. The same is happening in the chip industry. You're just forcing China to adapt much faster than it would otherwise. And they've done spectacularly well, I would say. They adapted their old plans to produce better chips. They still got the critical technology in, rightly or wrongly. You see some loosening in restrictions by the US. So, for instance, Japan and the Netherlands were excluded from these tax sanctions, and they're critical players in lithography. So without these two countries, these sanctions are kind of, they miss the point completely. And also the CHIPS Act, this huge fiscal push in the US, it's facing huge delays in in the pace of how fast these factories in the US get built. And there are reasons for that, differences in culture, lack of qualified manpower, costs. It takes longer than the current admin wished for, right? We still don't know when they will be productive. We still don't know how productive they will be. So, in terms of kind of the chip industry right now, I would say your kind of average chips, run-of-the-mill kind of chips, I would say it's probably on par, China and US and the West, whatever you mean by that. High-end chips, China lags by a few years. It's debatable by how many. Some say 10. I'm not so sure. I think it's maybe 1 to 3 years of catching up to do, but I think they'll definitely catch up. And I also think it's important to kind of differentiate because high-end chips they have very specific applications, maybe military applications, and all these large language models, all these things. But in terms of consumer electronics, you don't really need them, right? It's more a question of costs and price versus quality. And if you look at the stuff that Chinese companies are making, like guys like Xiaomi, for instance, it's good stuff for very low prices. I'm a big fan of the company in my kind of private life. We have all sorts of gadgets from Xiaomi, ranging from phones to, say, vacuum cleaners and all that, just your basic stuff. And it's very reasonably priced, and it's very good quality. So to me, it's debatable. Do you actually need high-end chips to increase your exports? I'm not sure. The last remark I would make is, a lot of these high-end chips where China is kind of lagging, they're produced on Taiwan. So, we have to make up our minds. Is Taiwan a separate country or is it part of China? If you look at diplomacy over the past, I don't know, 5 decades, it says it's China. So, the whole debate is kind of weird to me. It kind of assumes that Taiwan is a separate country, which it is not at all. So, I don't know. What do you think? Do you have any kind of insights?
Well, yeah, just a few points. We'll start with Taiwan. Yeah, I mean, okay, the US recognizes the one China principle, but it's, we know it's meddling and it's trying to provoke China into some sort of action militarily, presumably, so then it can say to the world, look, China's an aggressor, and then we should all sanction China like we so successfully sanctioned Russia, of course, which was an abysmal failure. But the US's principal concern, they don't care about Taiwan itself. It is to do with chip production in Taiwan. And they're fearful, well, if somehow in a formal sense, Taiwan becomes part of China in the sense that China invades the island, this is the US thinking, they'll then have control of TSMC. And then they'll control all the chip markets, and we're in serious trouble. It's kind of like, well, we've been trying to do this to China. Well, maybe they'll do this to us. That's the kind of untold story, and that's really what this is about. And if China just sits there and does nothing, then, which it shouldn't do, don't get involved in some sort of spat with Taiwan, then the US is just going to sit there and not be able to achieve anything. It's not clearly Ukraine and Russia. Another point I would make with regards to this, you're right in terms of putting sanctions and tariffs. I mean, they're an idiotic policy, but inevitably what seems to be happening is when the Chinese and the Russians put sanctions on the West, it has far more impact because they sort of do a cost to benefit ratio. What are the risks to us? And with regards to chip production, China has put restrictions on shipments of germanium and gallium to the United States. And if this carries on, the US chip production is going to fall off a cliff edge because they're absolutely critical raw materials needed in chip production. So this shows where, if you're going to try and, screw us over with regards to being in receipt of chips, then yes, we will develop our own markets, which are absolutely right in terms of that side of the equation. But, we can equally cause you immense damage, and this potentially could crater, semiconductor production in the US. And aside, you're absolutely right. As always happens, if you want to build something in the US, well, at least treble the initial cost that was anticipated, and at least treble the timescales in doing it. And, maybe it won't even happen at all. And that's already in place for a number of these projects. The one final point I would make is regarding lithography machines. Now, obviously, the world leader in this is ASML, which just happens to be in the Netherlands. It's a great company, but because they've, been trying to force them to put sanctions in place with regards to dealing with China, the big risk for ASML is because China's developing these lithography machines, and the statement was, well, it'll take them 20 years, 30 years. Oh, no, it's not. Maybe it's 10 years. Hang on, maybe they're going to have it ready in a couple of years or 5 years. Then all of a sudden, the risk to a company like ASML is that, and I mean, okay, we're speculating a bit, but China produces a like-for-like lithography machine in the future. Undoubtedly, China will produce it for a lot less cost. And all of a sudden, China could take a significant lead in selling lithography machine, and it causes huge damage to companies like ASML. And they've obviously are concerned about this, and rightly so. So I think that's a point, it's the old saying, necessity is the mother of invention. And if you're going to force the Chinese into having to manufacture their own chipsets and lithography machines, then be very careful of what the consequences would be, and don't have these blasé attitudes. Well, it's decades away, which the statement was made, and of course it's proved to be utter nonsense.
Yeah, I think that's the reason why Japan and Netherlands were excluded in the end. So not to damage them that much. I would also, on Taiwan, I would also advise anyone to look at the map and then to look at the trade components between Taiwan and China. And you'll see that the majority of trade is between China, like the biggest trading partner, obviously. Even if you treat them as, separate countries, which I don't, by the way. So, if these high-end chips are produced, or, the necessary components are getting sent into Taiwan for production, just looking at the map, I have a hard time believing that this technology does not get to China, to mainland China in some way or another. There's literally no way you can track it. If someone wants to send some chips on the ship to China, it doesn't take much skill, just a few customs officials that, will look away at the right moment. So just given the geography, I just don't believe it, So maybe the amount is kind of different because of the sanctions. Maybe the price is higher, stuff like that. But if someone wants something, they'll get it. And I think that's exactly what's been happening as well, despite all the rhetoric.
You're absolutely right. That's exactly what has happened. I mean,
Yeah.
it's a logical thought process, and if it's a logical thought process and it's something you can easily achieve, well, the Chinese will do it. Of course they will. Yeah. And there's no doubt that's been happening.
And there's a clear kind of economic motivation to do it both sides, right? So
yeah, absolutely.
I guess it's important to kind of speculate on, say Trump wins. He's known for his, anti-China tariff wars that failed miserably, but he's the kind of guy that could enforce something, extra, like more sanctions, more, build at home kind of thing. So that will be interesting to see, because sometimes he's not very rational, just like with tariff wars from the very beginning. Those tariff wars didn't make any sense from, an economic point of view, but he still kind of did it, right? So he's the wild card, I think, and he's admin. And it's also a question of who's going to be in key positions in his next admin and whether he survives to be elected, right? Given what's going on.
Well, yes, another assassination attempt. But anyway, that's a whole separate subject. But
Yeah,
yes, it is.
let's not go there.
No,
Not.
exactly. Let's not go there. But
Yeah.
so let's move on to the next subject, which I asked you if you could comment on, because I keep hearing people making statements about the Eurodollar system, and for me, it's something that's very opaque. It's very hard to understand. And I think there are people who try to infer that they have full transparency of what's going on, and personally, I find that very difficult to comprehend because it is by nature extremely opaque. So I thought it was good for people to get your thoughts on what what you want to discuss in this regard.
Yeah, so I agree. It's a very loosely defined idea. Um, I'm still looking for a proper definition, like a scientific academic definition, and it doesn't seem to be around. So when people mention Eurodollar system, some of them talk about Eurobonds, which is obviously wrong. It's just a section of the market, and it dates back in history when some bonds were offered in Europe and they were typically dollar denominated, and that's what it means. So it's not really about the Eurodollar system. Others talk about, complex, kind of semi-complex derivatives on the central bank side, swap lines, coordination between central banks, and how their relative financial systems get access to central bank liquidity and how they use these instruments. Another take is that it's just about US denominated deposits in foreign banks and vice versa. So it kind of matters how you define it to really talk about it. And there's no definition, right? So, it's a difficult one. For me personally, I think of the Eurodollar system as the totality of market assets denominated in two key paper currencies, so euros and dollars. And this pretty much includes everything, the balance sheet derivatives, like all types of swaps, repos, foreign repos, depending on which kind of repo market you're talking about, but also your standard assets like stocks and bonds and deposits. So for me, it's kind of the totality of the liquidity of two major parts of the global monetary system. Obviously, some assets are more important than others. So, sovereign bonds are critical because it's the actual reserve asset that you use as your collateral and as your kind of pricing mechanism. Um, and this is due to their size primarily and how they're used in all sorts of collateralized trades. I would also say that in terms of liquidity, the system kind of feeds off itself. So if you look at historical interest rate cycles, whether easing or tightening, you just look at the charts and they're obviously coordinated in US and Europe. They sometimes lag each other, but the idea that one is in a hiking mode and the other one is kind of dropping rates, it's just not valid historically. And I think the spread between interest rates is also obviously coordinated and managed. So it's to me it's one liquidity, right? So it makes things in US super important for Europe and for European institutions, especially in the financial industry. Um, so I don't know if my answer is satisfying, but that's what I think about it.
No, it's perfect. I mean, it gives people the clear indication that it isn't clear what it is. It is opaque. It's not particularly transparent, and therefore trying to make definitive statements about it, I don't think has, from a personal perspective anyway, validity. I mean, I'm not denying that it's an important market, but to try and dissect it and give specific answers, I think is just not possible because it is so opaque. But I wanted people to get your idea. Okay, what does it broadly cover? And I think that you've provided a nice sort of concise summary of it, and it's just to give people a bit more sort of information background that when they hear people mention this, what does it mean? And I think that was the point of including this in the conversation.
There's no magic in it, it's just the way the system works basically. And obviously if you're talking about two major parts of the global economy, those issues are going to be influential. That's why a lot of people talk about this, I think. I don't really like people focusing on it. Like a couple of guys I know, they built a career out of it. That's the only thing they talk about also online. I think it's very narrow, kind of. I don't think it has any predictive value for markets, or at least it should be considered a part of it. Can't be just based on that.
Yeah. So I know part of, things we've discussed offline and is the US dollar yen. I'd like you to put some perspective on this, because as you rightly say, Forex is very poorly understood. And I think that's an interesting discussion point, given obviously what we've seen in recent months with regards to dollar yen and what the Bank of Japan has done and might do in the future.
I think look, it's weird that people don't really understand FX, or they kind of don't put enough emphasis on it. But it's critical, I think, at this point, especially if you believe that a lot of extra dollars are going to be printed, but also not just dollars, probably other currencies as well. So Japan is a unique country in two ways. One, it's the largest foreign holder of U.S. Treasuries, and two, it has a huge positive net investment position, meaning they have stuff they can sell and repatriate in certain situations. And I think dollar yen is a great example of how FX can influence capital flows, because we saw this kind of wobble in the global markets in August, and it coincided with the BOJ's efforts, to intervene in currency markets at around 160. They've been doing it for a year now at different levels, but it seems like 155, 160 is their kind of line in sand, red line, if you will. So, given these two properties of Japanese reality, especially the second one, which relates to the net investment position, when you have BOJ on your side with clearly defined defense range like we have now, it's actually a great motivator for Japanese corporates or households to sell their US dollar assets, sell dollars and repatriate yen. Well, because it's likely that yen is not gonna go down anymore, at least not as fast, and there is some sort of floor. But also because inflation in Japan has been lower than anywhere else in the Western world, at least. So not only your dollars are buying you much more yen, but it kind of preserved its purchasing power better than other currencies. So it makes a lot of sense to repatriate yen at this moment. So I think the wobbles came from Japanese selling their US assets, in particular US stocks. And I think it will continue. The more dollar falls against the yen, the bigger the incentive to do so. There are different estimates of how big this net investment position is. I've heard numbers of 4 or 5 trillion. I haven't done my own research on this, but it's quite significant to influence markets. And it's interesting, it's interesting that BOJ, Bank of Japan, is actually one of the best FX traders I've seen in my life historically, and I've been following them for a while. I've seen interventions both ends, to make yen cheaper, but also more expensive, like now. And it's amazing how much crap they're always getting for supposedly getting things wrong all the time, but they don't. They actually trade very, very well and make profits on their kind of interventions in time, of course, not straight away. So I find it bizarre when people laugh at BOJ. It just doesn't make any sense to me as an FX guy, you know. But I think the important part of it is just to show big of a how big of a part FX plays in decision making when you consider your investments in your currency base. And from my experience, FX vol has been so low. Okay, we've seen some in yen, but Eurodollar is kind of steady over the past decade. It's around 110 really. And I think people they just forget, they stop thinking that it's possible, to see Eurodollar at 150 or something. To me, it's entirely possible. I don't know. I'm not betting on it at the moment, but I have to account for risk. And I think it just shows that capital flows could be a function of the dollar, because it's one thing to invest in US when the dollar is steady or even going up against your currency, but it's a very different proposition in a weak dollar environment. And foreigners own a lot of US assets, not just Japan. And if US bond and equity markets just stay flat, let alone fall, it could lead to capital outflows and impact the prices of all key markets. And I think this, coupled with the fixed volatility, it's underappreciated. It's not given enough thought. I see it every day. Like, we do this exercise for our clients and for new clients and existing clients, which I call scoping, and basically, I just look at the portfolio, me and my team, and we try to identify these unaccounted for risks or, problems, potential kind of uh, problems that could be present given our view on the markets and the economy. And all I see is just a complete disregard for a fixed risk, especially for guys who are living in euro terms. That's the majority of my clients. So, it's super important. And I think if dollar goes down significantly, and I mean, something like 20%, 30%, it will have an impact on other asset classes by definition. And I don't think enough people understand the implications. And again, it's one thing to consider this from an American point of view when your currency base is dollars, but it's quite another for foreigners. And given the amount of assets that foreigners hold, it's a clear problem. That's actually part of the reason why this admin was fighting the dollar weakness thing so much with the hikes and everything. That's obviously part of the reason to make it attractive for foreigners.
Yeah, absolutely. The only thing I would add from my perspective is I think you're absolutely right. The Japanese, just to highlight as an example, do have a lot of US dollar denominated asset. And the BOJ is kind of saying, well, we're not frightened to hike rates again. And there's this perspective, they can't hike rates. Well, let's wait and see first if they do. But if they did, the implication, I think you're going to see a lot more dumping by the Japanese of US or dollar denominated assets, and therefore they'll repatriate the money and put it into Japan itself. There's clear evidence that's already happened, and I think that's exactly what will happen. To what extent is debatable, but I think you will see capital outflows from the US to Japan on that basis. Now, if the dollar gets weaker and the US starts cutting interest rates, then okay, I mean, maybe you can extrapolate that across the board, but I mean, that's a bit of a, it's as broad as it's long making that assessment. But certainly, you're right. People think the Bank of Japan's a bit of a laughing stock, and but they were very calm, and I think, like you say, 160 was a line in the sand. They went, right, we're going to do something about this. I mean, okay, it's let's see where we are in 6 months or a year, but thus far they seem to have defied a lot of people's expectations, and maybe they will continue to very slowly raise interest rates, and that is certainly going to have broader implications. And for me, one of the biggest questions for Japan is just, this is a political statement, stop being a vassal state of the US. I know that's extremely difficult for them because they would hugely benefit, for example, to not be trading, because they're very energy dependent, obviously, on other countries. Don't trade it in dollars, because that would be hugely beneficial to them as well. So, but that's a whole political statement. I think eventually Japan will start to assert itself. I mean, it might take a long time. It might not do, depending on broader developments in the world itself and all this big paradigm shift that's ongoing. But I think Japan also has to stop being antagonistic with the Chinese on at the behest of Washington. So there are things that could be immensely beneficial to them, and because if they integrate into multipolarity, the Belt and Road Initiative, I think this will be hugely beneficial to Japan. But I'd also make a point, and this may seem a bit conspiratorial, but I have a feeling there was deliberately an intention of attacking the yen. And this is why it weakened the way it did, but they've responded, and thus far they've made the right decisions. And it's something for me on a personal level I'll track with interest going forward. I always find Japan to be quite a fascinating country, and for many reasons. And I think the discussion we've just had is just part of that whole sort of interest that I have.
Yeah, so just to add on that, yeah, this deliberate, not deliberate kind of debate. There's this idea that's been flying around that by attacking yen, you kind of by proxy are attacking yuan. But it's just an idea. I couldn't find any proof of that. I think they're completely different kind of setups.
No, there's
But
no, I don't.
but that
I don't agree
but
with that at all. But that
yeah,
would be the reason to attack it. But I know there's people who, I don't know how they come to that conclusion. That's just, I don't see any evidence to support that assertion at all.
well, yeah, I don't agree with it either. But I guess the idea is that it's a fund, like yen is a funding mechanism for China. That's the explanation. Again, it's very kind of dubious to me. I don't agree with it. I think yuan is a separate topic. And it's funny how people stop talking about dollar yuan as soon as yuan is back in its range. It's so tiring every time yuan changes a little bit, and there's all these conspiracy theories flying around. Oh, they're going to devalue, blah blah blah. Well, if they're going to devalue, it's just going to make their surpluses bigger. That's all that's going to happen. So that's exactly the opposite of what US wants. So it's the whole idea is kind of dumb, I would say. I would also add, like it's not directly about foreign exchange, but it's related. So with the rates going down and with US just entering this easing cycle, there's this linear assumption that low rates would lead to higher stocks, high US stocks. And I think it's very linear and very naive. I don't think it's that you can take this, part of the equation and project it to the end result. I would argue that FX is the bigger influence right now, just because the amount of money issuance is unknown, but we all know that it's going to be massive. Right. So it could actually be a bigger motivator for foreigners than the relative interest rates. So just to end on that.
Yeah, absolutely. So I think we've done just about an hour. So, I mean, we can carry on, do a bit more. We had a section on sort of politics, or, if we want to carry on, or we can park it maybe for another chat some other time, because I think there's quite a lot in that. So how do you feel?
Yeah, maybe. Yeah, I think we've covered like the important stuff because all this geopolitics stuff, it's kind of conversational, right?
Sure.
I think maybe it's better to talk about this stuff after we see the BRICS meeting, the next one, because it seems to be a very important one. And I think when we do that, it would be a good context for discussing China and what's happening in their financial system, because there's a lot of kind of fog in there too, a lot of stupid takes, not kind of based in reality, but just wishful thinking. So I think, yeah, it's probably a separate topic, and we could focus on that the next time we, do this.
Yeah, and I think you're right. It's probably good to do it after the summit. I mean, I know
When is
equally,
it, by the way?
I can't remember, sometime in October. I can't remember the exact date.
This year, right? It's
Oh,
this
yeah,
year.
yeah, yeah. It's in a few weeks. So it's kind of would tie in well to, let's see what the actual fallout is. I mean, there's a lot of people very euphoric about what's going to happen. And of course, the flip side, the people who are very anti-China go, it's a non-event. Well, it's probably going to be neither. I think there's some balance in the middle, but certainly I think we need to be interesting to discuss, this
Well,
this
we could
section on
do,
the basis of that once it's happened.
yeah. I think we could do another chat closer to year end,
Yes.
somewhere sometime in December, because we will probably know, well, given it's US politics, I'm pushing it here, but we'll probably but we'll but we'll probably know who the next president is, and we could discuss that, and we'll have the BRICS thing out of the way, and it sounds like the right time to discuss what happened over the year, but also what the next year brings, because I think 2025 is going to be very interesting because of these things, because they're happening now at year end.
Yeah, absolutely. So obviously, Paul, thank you for joining me today. It's always a pleasure, as you know, and hopefully in the not too distant future, Lisa and I will be able to come and see you again in person.
Hopefully, it's always my pleasure as well. I hope I didn't bore anyone to death.
Absolutely not.
So, and I would love to come back.
Yeah, thanks. And with
And the
that,
visit, yes, I'm waiting for you to visit me in
yes,
person.
we're looking forward to seeing the family as well, obviously. So, sorry, that's
Yes.
just a bit of a personal aside, not really relevant to what we're doing, but anyway, thanks again, Paul, and obviously we look forward to catching up with you sort of the back end of this year.
Thanks.
With that, I'll end this conversation.